We've brewed our coffee, folks, and we've got our Wall Street Journal, which means it's another weekly report where we're going over the news, the basic things that you might want to know, especially regarding your gold, silver, palladium, copper, all that kind of stuff. We're going to check the markets. We're going to check the metals. We do that type of stuff. So today we're going to begin by looking at the three pillars of the 2026 economy, the resilience of the American labor market, and the escalating scarcity of industrial inputs, and the total revaluation of our friends, the precious metals. The headline story on Wall Street this week remains the decoupling of the S&P 500 from traditional interest rate expectations. According to the latest report from Goldman Sachs Global Investment Research, we are seeing a productive premium drive equities to record highs, fueled largely by the integration of the second-generation AI stack into the manufacturing sector. However, that growth is hitting a physical ceiling. And that ceiling is made of copper, silver, and lithium, like you would have in batteries, of course. In the commodities pits, silver has dominated the conversation, per the Silver Institute's March 2026 interim report. Industrial demands for photovoltaic cells and the 6G infrastructure rollout has created a structural deficit for the fourth consecutive year. Shocker there. We are no longer looking at silver as a mere speculative asset. It is now the most critical bottleneck in the tech supply chain. Moving to the yellow metal, gold has maintained its high floor, and we'll get to that in a little bit, which isn't just retail fear. The IMF's Global Financial Stability Report released Tuesday indicates that central banks, specifically the Global South, have shifted 12% of their total reserves out of sovereign debt into physical bullion over the last 18 months, as the Financial Times noted in their lead editorial yesterday. We are witnessing the quietest revolution in the history of the dollar, a transition towards multipolar reserve system where physical assets, right here, are the only recognized neutral ground, which is an interesting place to be. In the energy sector, the story is one of transition friction. The International Energy Agency, the IEA, as most of us know it, updated its 2026 outlook this morning, noting that while renewable capacity has doubled, the demand for the baseload reliability has kept Brent crude stubbornly pegged between $85 and $95 a barrel. Despite the green mandates of the early 2000s, the U.S. Energy Information Administration, or EIA, reports that domestic shale production is currently the only factor preventing a global energy price shock. And as we know, with everything going on in the Middle East and America getting into its strategic reserves, that's kind of the balance that they're playing until things level back out. And finally, we look at the domestic front. The Bureau of Labor Statistics' most recent JOLTS report, blue-collar premiumization. The cost of labor in the mining and extracting sectors is rising at twice the rate of software engineering. This is the real-world economy reasserting itself. Investors are no longer asking if a company can scale its software. They're asking if a company has mineral rights and the energy contracts to actually build their production. According to BlackRock's 2026 Global Outlook, the great tangible rotation is now fully underway, which is an interesting thing for us who like this. Companies going out and getting access to mines and mining things for their companies rather than buying them on the open market will be an interesting new thing that I have not seen play out before. So the era of cheap, infinite digital growth has met the reality of the finite physical world. Those who hold resources are quite literally holding their future, which is an interesting thing to think about. We see technology oftentimes, this digital age, is an intangible thing. Yes, you might hold a phone in your hand, but all of the things going on the phone, we don't really think as a tangible thing. We're not scrolling information tangibly. But somewhere that is requiring servers and wires and all of the things that need physical products. And those physical products come from the ground and the wires, copper, and all of the connective parts of the computer here, silver. So that's a very interesting thing to think about as companies are shifting to make their own logistical mining process so that they can get the supply they need consistently. But let's go ahead and get to the markets. As we know, lots of crazy stuff happening around the world. War all over the place. And markets don't really tend to like that. So as we see, the Dow Jones Industrial here, 46558 is where we close. It's down 119. It has not been a fun ride. It is down 0.26%, all-time high being the 10th of February. Look at the mountain. You could ski on that right there. S&P 500, 6632, down 40 points or 0.61. All-time high was the 27th of January. This is definitely not a bunny slope here either. Do you see that? And then we have the NASDAQ Composite, which has not been the friendliest of the indexes for sure. 22,105, 206 down, almost a full percentage point. And our all-time high for this was at Halloween of last year. Definitely not a fun place to be. But did America find itself in a unique situation when it came to its losses this week? Well, not at all. As we noted before, as America goes, so too does the rest of the world when it comes to the economy. Canada right here is down 0.66. We have Brazil down 0.52. We have Chile up 0.67. Good for you. Mexico's down. EMEA down 0.50. You got the Eurozone down 0.54. We've got Belgium down 0.54. We've got Denmark on the upside, though they're still down 12% on the year. France down almost a full percentage point. Germany 0.6. We've got here, I'm just looking for things that are fairly big swings. South Africa down almost 2 percentage points there. We have Sweden 1.28. We have Turkey 1.45 right there. We go to the Asia Pacific. China down 0.82. You have Hong Kong down almost a full percentage point. We have India down almost 2 percentage points. They're negative 12% on the year in India. Japan 1.16 on the downside. South Korea 1.72. Taiwan 0.54. And Thailand 1.43. So lots of things going on in the world, which is leading to lots of issues when it comes to the markets. The international market not doing so hot. But what about your gold and silver, folks? Well, let's go ahead and take a look at what that was for this week. Silver ended the week down $81.34 per a troy ounce. That is down 3.44%. But all hope is not lost, folks. As we remember, we're still up on the year from January. As our $81 that we sit at right now is still $9 more than when we started at the 1st of January. So we're still up 12.53% year to date. Gold, a little bit different story. They're up this week. They're at $5,036 as this week closed, which is an interesting place. It was pretty neutral this week, and it seems to be that at the floor of gold is sitting around that $4,800 mark. And it's sitting at a pretty good place right now. It gained $23 this week. It's almost a 0.5% up. Nothing crazy there. Year to date, however, it's gained $702, which is 16%. So gold is the winner of the week again, and it is currently winning the year. Fantastic stuff there. Hope you enjoyed this. Thank you so much for watching. We'll do this every single week that we can, folks. And as always, please remember to stay classy and current with the culture of currency.